We continue to track shares of Ford as the company tightened its profit outlook for the year and pulled the plug on autonomous driving platform Argo AI. Ford CFO John Lawler joins us now alongside Yahoo Finance senior auto correspondent Pras Subramanian. John, good to see you again here. Let's start with Argo AI, getting a lot of attention here in the early going. Why did you pull out of this, and what does that mean for your autonomous driving efforts?
So when we looked at the business opportunity here, we saw that the arc to a scaled, profitable business was a long way off, 5 years plus out. And so what we've decided is that we're going to reallocate our capital. We're going to focus on L2 plus and L3 driver assistance technologies, where we can give our consumers time back in their vehicle in the near term and give them a better experience. And we think that that's going to be a much more profitable scaled business in the near term. So it's really about allocating our capital to where we see strengths, where we see the opportunities, and adjusting our business as we see fit.
Hey, John, Pras here. Just want to follow up on that Argo discussion here. Is it just that we don't have enough clarity as to what it would take timing-wise, money-wise to get to level 4 or level 5?
Well, I think from a technology standpoint, I'm not a technologist, but I think we have some of the best technologists in the world working at Ford Motor Company. And they believe that the technology, there's a lot of hurdles that it needs to cross through before it's able to provide a scaled and profitable business. And that's what's key, a scaled and profitable business. Likewise, it's not just the technology, it's the business model that has to be built out. It's the number of vehicles to scale that across the country. It's the depots that are going to have to manage those vehicles. It's very expensive. It's going to take a significant amount of capital to build that out. It's going to take quite a bit of time, in our opinion. And therefore, then we pivoted. We decided to allocate the capital to L2 plus and L3 driving technologies, as I said, which we think has a much more immediate opportunity for us as a business.
When do you think we'll get to full self-driving, John, at this point? It's Julie here. I mean, does that happen 10 years from now, 20 years from now? Never?
Well, you know, in the industry, it moved really quickly at first, and then it's that last 5 or 10% that's been difficult to solve. And it seems that we thought we were close, in the next year for the last 5 years. And it's taking time for that to develop. And when you listen to certain technologists, they'll tell you that the problem is extremely difficult to solve. It's one of the most difficult problems facing us today from a technology standpoint. So our view is it's at least 5 years out. And with that, we pivoted.
You've seen some higher supply costs right now. And for those suppliers that you're working with, how successful are the negotiations just to keep the supplies that you need to work through this backlog of vehicles that are perhaps lacking parts, just to keep the costs the same, so that is a constant that you can expect going forward even into next year?
So we have seen inflation costs hit our business. We saw that in the third quarter as we guided $1.4 billion to $1.7 billion adjusted EBIT. We came in slightly above that. Inflation and supply costs were a big part of that number on a quarter-over-quarter basis being lower. So we're continuing to see that. Labor's tight, supply chains, ocean freight, domestic freight, all very expensive right now. So we're seeing it across the board. So the important thing for us is to work with our supplier partners, look to drive efficiencies. We own a lot of the opportunities that we can work with our supplier partners. They're being very proactive and collaborative with us. I think it's the same for everybody. Right now, inflation is hitting all of us. We have to work collaboratively. We have to find productivity. We have to work on the cost reductions, eliminate waste. And we have plans to do that, and we're implementing those plans. So I think it's a similar play for most companies out there today, given the inflationary environment we're in.
John, I was sad to see in news this week, it went viral, the Fiesta. It's gone. I remember my friends had that back in high school. Are there other models in your lineup that you can cut to save some costs?
Well, I think when you look at what we're doing there in Europe with the Fiesta, it is a product that's been around for a long time and it's beloved in Europe, is that we're moving towards our electrification plan. And this has been part of our plan for a while. And that's just another step in that direction. And you'll start to see more electrified products come out in Europe over the next year. And it's a transition plan. And I think we're going to see more of that as we move to an electrified lineup. As we move forward, we're going to have production capability for electrified vehicles of 600,000 units next year, on the way to 2 million units by 2026. So we'll see more of this as we transition and we move to new nameplates and we move to new battery electric vehicles. So it's just part of the transition the industry's seeing as we move forward.
Hey, John, speaking of the industry, are you guys seeing any demand or sort of a slowdown coming from the economy or rising rates?
So we are starting to see some signs that the inflation and the higher prices are impacting the consumer. What we're seeing is a narrowing of what consumers are willing to pay, or a discount versus the suggested retail price is a bit higher. We're also seeing that consumers are looking for longer-term loans, 84 months and beyond, given that payments are higher. They're trying to keep that payment into a range that they think is affordable. And we're also starting to see the mix shift on some of our iconic vehicles like the F-150. We were seeing the turn rate on our highest series like a Lariat turn faster than a mid-series like an XLT, and we're starting to see that shift where the XLT is turning quicker than the Lariat. So they're starting to see the early signs. We're watching them closely. We're going to keep abreast of that. But given the total macroeconomic environment, the inflation, and what the consumer's been facing, we're starting to see that come through in some of the signs for us as a business.
And what about globally, macroeconomically? If you think of China, this most recent quarter there, you have to look through some of the different competitors in that space, I imagine, and look across some of the consumer demand to really understand and look into the data about where they're opting for some of the homegrown brands, as we had been seeing that show up in some of the other automakers industry, if you will, players, reports that have come out thus far.
Well, when you look at China, it is a really dynamic market, and it is transitioning to BEVs much quicker than any place else in the world. And there are some very good local Chinese BEV manufacturers, and they're having an impact on the industry. And when you look at our China business, Lincoln's doing very well. Our ICE business, or internal combustion engine business, is profitable. It's really the transition into battery electric vehicles in China that we're working on in a very tough and competitive market. Some of the local Chinese players they're the real deal, and they're formidable competitors, and you're seeing that show up in the marketplace.
All right, we'll leave it there. Ford CFO John Lawler, always good to see you, and good to see you as well. Yahoo Finance's Pras, Subramanian. We'll talk to you guys soon.